Let us see the next question. From following information, calculate CF18 cash flow after taxes. Contribution 2 lakhs, annual cash fixed cost 1,20,000, depreciation is 0, income tax rate is 40%. Now based on this information, we are required to find, say, cash flow after taxes. Let us have understanding how we can calculate the answer. We can start with the contribution. It is an amount of rupees 2 lakhs. Then information is given about the cash fixed cost. It is 1,20,000. Depreciation is 0. Contribution minus cash fixed cost minus depreciation is profit before taxes. That is 80,000. Income tax at the rate of 40%, that comes to 32,000. Profit after taxes is 60%, that is 48,000. Depreciation is 0, that is add back of the non-cash item, and CF80 is 48,000. This is the way we can make the calculation of the CF80. Please write an answer. Now we understand that, say, in the subsequent question, the question says like this. So next question, calculate the device CF80 for the above question. If it is given that the contribution is 2,40,000 instead of 2 lakhs. Everybody is requested to pay attention properly. This is 2,40,000. So that is an increase in the contribution by 40,000. So we understand like this. The present CF80 48,000 plus 40,000 into 1 minus 0.40. Because what happens, I'd say, whenever there is an increase in the contribution, your income tax liability will also increase proportionately. So it is 40,000 into 0.6, that comes to 24,000. So we understand that, so the CF80 would be 72,000. Let us check. 2,40,000 minus 1,20,000. That is the cash fixed cost. Depreciation is again 0. So profit before taxes is 1,20,000. Income tax liability will be 48,000. Profit after taxes 72,000. Depreciation is 0. So CF80 is 72,000. You can understand something like this. The contribution increases by 40,000. So 40 into 40%. Your income tax liability increases by 16,000. So 40 minus 16, cash flow increases by 24,000. This is the way the amount of the cash flow increases with the increase in the contribution. So friends, importantly we understand, always remember that whenever there is an increase in the income, at that time, say there is no increase in the cash flow with the same amount. Because with the increase in the income, your income tax liability will also increase. So your cash flow increases with the post-tax value. This is what we understand over here. So next question, calculate CF80 if at all the annual cash fixed cost is 90,000. Okay. So now friends, instead of 120, if it is 90,000, we are required to make calculation of answer. See, there is decrease in expense, yes. So cash flow increases. What is the amount of the reduction of the expense? 30,000. So cash inflow will increase by 30,000? No. It will increase by the post-tax value. So we can say something like this. It will be 48,000 plus 30,000 is a reduction into 1 minus 0.40. So 48,000 plus 60% of 30,000, that comes to 18,000. That comes to 66,000. So cash flow will be 66,000. Let us check this value. This is an amount of 2 lakhs. Yes. This is 0. Yes. This is 1,10,000. Yes. 40% of income tax liability. So tax is 44,000. This is 66,000. This is 0. So this is again 66,000. We understand logically that 30,000 into 40%. 12,000 rupees is the amount by which the tax liability increases. So from 32 it increases to 44. This is what we understand. Next, annual cash fixed cost is 140 instead of 120. So over here, so this increases to 1,40,000. So there is an increase in the expense by 20,000. So when expenses increases by 20,000, cash flow will reduce? Yes. Will it reduce by 20,000? No. Why? Because it is an allowable expense from tax point of view. So your income tax liability will also reduce accordingly. We understand that's a 20,000 into 0.6 in this example. 12,000 rupees is the amount by which the cash flow will reduce. So we can say something like this, that 48,000 minus 20,000 into 1 minus 0.40. So 48,000 minus 12,000. So it comes to 36,000. Let us check the answer. This is 2 lakh once again. This is 0. This is 60,000. It is 24,000. This is again 36,000. This is 0, and ultimately we get the answer of exactly 36,000. This is the way we have to understand the logic of the change in the income or expenses and change in the cash flow. Next, the question says that the contribution is 190 instead of 2 lakhs. So there is a reduction in the contribution, yes. So cash flow will reduce, of course. There is a reduction in the contribution by 10,000. So cash flow will reduce by 6,000. So we understand that it is 48,000 minus 10,000 into 0.6. So 6,000 is a reduction. So this will be 42,000. This is 120. This is again 0. This is 70,000. This is 28,000. 42,000. Again add back depreciation 0. And this is 42,000. This is the way we can have so the working to be made. Next question. It says that there is a depreciation of 25,000. Okay. Now, dear students, importantly, depreciation is an expense, but it has a feature that it is a non-cash expense. So what will happen? So there is no cash outflow, yet as it is an expense, it is able to fetch depreciation tax saving advantage. So what will happen? Instead of a reduction in the cash flow, there will be an increase in the cash flow. So it is 48,000 plus 25,000 into 0.4. Why? Because income tax rate is 40%. So 48,000 plus 10,000. So the cash inflow will be 58,000. In a way that says still there is an increase in the expense, cash flow increases because this expense is a non-cash in nature. So this is 2 lakhs, this is 1,20,000. The amount of the depreciation is 25,000. So it is 80 minus 20, 60, so 55,000. 40% of that comes to 22,000. This is again 33,000. 60% value plus 25. So it comes to 58,000. You have to understand it like this, that this was 32,000, this has reduced to 22,000. So that 10,000 rupees is considered to be DTS. DTS stands for depreciation tax saving. Depreciation tax savings. That is the way, so it will have, so the cash inflow, and with that, so the cash inflow will increase rather than reduction. So we can have a kind of summary like this, that whenever there is an increase in the income, cash inflow increases with the post-tax value. Whenever there is a reduction in income, cash inflow reduces with the post-tax value. Increase in the expense, cash inflow will reduce with the post-tax value. Decrease in the expense, cash inflow increases with the post-tax value. And as far as the non-cash item depreciation is concerned, it will generate only the tax saving, that is depreciation into tax rate, and that is the amount by which the cash inflow will increase. So I'm just dictating to you a small conclusion. The conclusion is like this. If at all there is an increase in cash income and or reduction in cash expense, in this case cash flow increases by post-tax value. That is amount into 1 minus t. So if at all there is an increase in the cash income or reduction in cash expenses, cash flow increases. If at all there is increase in cash expense and or reduction in cash income, in that situation what will happen? Cash flow reduces by post-tax value. It is amount into 1 minus tax rate. This is what we understand. Last, depreciation. In that write down, as depreciation is a non-cash item, comma, so due to depreciation, comma, there is tax shield, comma, tax savings, full stop. So cash inflow increases by DTS, depreciation tax shield slash savings, and it is found as depreciation into tax rate. This is the way, say, it is calculated.